Welcome to The Explainer. Today, we are diving deep into a financial earthquake, one that started in Tokyo but sent tremors through portfolios all around the world. We're talking about the collapse of a multi-trillion-dollar strategy and what it means for global liquidity. Because believe me, the rules of the game have just changed.
Okay, let's kick things off with a statement that sounds, well, kind of crazy. A central banker in Japan makes a decision, and all of a sudden holding on to your favorite tech stocks right here in the US gets a whole lot more painful. Sounds like a riddle, right? But it's the reality of how connected our markets truly are.
So this is the big mystery we're going to solve today. The connection is this hidden river of money that's been flowing almost silently, just beneath the surface of the global economy for decades. And understanding this flow, well, it's the key to seeing why markets can suddenly go haywire in ways that just don't seem to make any sense.
All right, so to really get this, we've got to pull back the curtain on the engine that was driving this whole river of cash, the carry trade, specifically the Japanese yen carry trade. You know, this has been one of the biggest, most powerful institutional trades for the last 30 years, and its recent breakdown is sending shockwaves absolutely everywhere.
So what exactly is it? Well, imagine this. You get a loan from a bank at, let's say, pretty much 0% interest. Then you take that exact same money and you put it in a savings account at another bank that pays you 5%. That profit you make just from the difference, the spread, that is the carry. You're literally making money just by moving it from a low-yield place to a high-yield place. It's basically financial arbitrage in its purest form.
Now, for the big players, we're talking huge hedge funds, major institutions. The process was just that simple, but they were doing it on a massive global scale. First, they'd borrow billions of Japanese yen for practically nothing. Second, they'd swap all that yen for US dollars. And third, they would plow that money into the US market, buying up everything from government bonds to those high-flying tech stocks on the NASDAQ.
And this is the reason the whole thing worked for so long. You had the Bank of Japan, which for decades kept its interest rates pinned to the floor. We're talking at or even below zero. Meanwhile, over in the US, you could get much higher returns. This massive difference created what was basically a one-way fire hose of cash, just pulling money from Japan and shooting it straight into US assets. For years, it felt like a sure thing.
And the scale here, it's just mind-boggling. I mean, with its government debt at over 260% of its GDP, and after 27 different rounds of quantitative easing, Japan really had no other choice but to keep rates incredibly low. This turned the yen into the undisputed king of funding currencies. It was the cheapest, easiest money on the planet for big investors, and it became the foundation for countless other investment strategies all over the world.
But here's the thing. What happens when that machine, that seemingly endless spigot of cheap money, just stops? Well, the entire global money machine gets thrown violently into reverse. This is what everybody's calling the Great Unwinding.
So what was the trigger? It all came down to one single historic move. The Bank of Japan finally signaled an end to its negative interest rate policy. It hiked its rate above zero. Now that might sound like a tiny change, but for a trade built on razor-thin margins and gigantic leverage, it was a seismic shock. That profitable spread, the carry, was suddenly about to vanish.
Think about it like this. This whole trade was built brick by brick over decades. But when that foundation finally cracked, the demolition happened in a flash. The unwinding wasn't some orderly retreat. No, it was a panic stampede for the exits, and it all happened in just a few short weeks.
And the damage? Absolutely staggering. We're talking an estimated $200 billion in these carry trades getting unwound, which in turn wiped out, get this, $6.4 trillion from global markets. This wasn't just a minor correction. It was a major liquidity event, a sudden, violent withdrawal of cash that left the markets completely gasping for air.
Okay, so this is the really crucial part. How does a massive hedge fund having a bad day in Tokyo end up becoming your problem? How does this chain reaction rattle your retirement account? The answer, in 2 words, is the domino effect. Because in today's financial world, no one's an island. When one group of investors is forced to sell, it triggers selling by others, creating this cascade that can cross oceans in an instant.
So let's break down exactly how those dominoes fell. 1, the Bank of Japan hikes rates. 2, suddenly all those traders are losing money on their yen loans, so they have to pay them back, and fast. 3, but to get yen, what do? They have to sell the stuff they bought with it, their US stocks. 4, and here's the key, in a panic, you don't sell your garbage, you sell your winners. You sell what's easy to get rid of quickly, like a super popular stock like Nvidia. And 5, a tsunami of sell orders hits the market all at once, overwhelming all the buyers and causing prices to just plunge.
And this all leads to a pretty brutal truth, right? If you owned a portfolio of US stocks, you were, without even realizing it, making an indirect bet that the Japanese yen would stay cheap forever. You basically became an accidental currency trader, and you probably didn't even know it. And when that bet went south, your portfolio paid the price.
All right, I know this all sounds incredibly complicated, maybe even like something you have no control over. But that's not totally true. There are actually signals you can watch for, like an early warning system, that can help you see the pressure building before the whole thing breaks.
And the biggest one you need to know about is a currency pair, USD/JPY. All this tells you is the exchange rate between the US dollar and the Japanese yen. You should think of this pair as the canary in the coal mine for global liquidity. In fact, it's often a leading indicator for volatility in the NASDAQ.
So here's the cheat sheet, the simple way to read the signal. When the number for USD/JPY is falling, it means the yen is getting stronger. That's your big red flag. That's the warning that traders are selling dollars to buy back yen to pay off their loans. The carry trade is unwinding. Now, if the number is rising, it means the yen is getting weaker, and the trade is probably stable for now.
And there's one more thing you can watch, something that pairs perfectly with this, the VIX, also known as the market's fear gauge. When that unwinding happened, the VIX shot up like a rocket, signaling that risk and panic were spreading fast. So watching for a sharp, simultaneous move, a falling USD/JPY and a spiking VIX, that is a powerful combination for spotting trouble on the horizon.
Look, the carry trade is really just one example of the hidden plumbing that makes the whole global financial system work. Its collapse is this powerful reminder that sometimes the biggest risks are the ones you can't even see. It really makes you stop and think, doesn't it? What other hidden risks, what other silent bets are sitting inside your portfolio right now?